Welcome to HYCM's online trading workshop with myself, Giles Cochran, Chief Currency Analyst here at HYCM. Hope everybody is doing well. Looking forward to just taking us through the current session. And don't forget that we have the question and answer section that you can fill in as we go through the webinar. Hope everybody is doing well. Nice to have you all on board. Very warm welcome. Selva, good to have you. Warren, Will, Yasser, great to have you guys here. Now, just as we get stuck into the HYCM webinar, don't forget that as we're looking at different setups, different situations, we will be looking at different potential entries and exits. The whole idea of this is from an educational perspective, so that you look at this and understand how someone with a professional trading background goes about understanding the financial markets. It's not trading advice. The reason for that obviously is first of all, we don't have the license for that, but secondly, it's the fact that market conditions are constantly changing, so you have to sort of be staying tuned into what those market conditions are, and seeing how I analyze the markets will help you with your market analysis as well over time, so you can make your own trading decisions. I know some of you guys well, and you know you're well developed in your market understanding, and some of you who've just joined the webinar, it might be totally new for you. So that's just by way of introduction. Now, as we enter the markets for today, we're just going to first of all have a little summary about where we're at. And we're in a risk-off market, and we are seeing the risk-off tones from last Friday still flowing through the session today. So we'll just briefly go over to the screen before we start looking ahead at the calendar. We'll just briefly look ahead at where we are with the market sentiment. Now, Asia market traded a little bit higher in some of the indices, but broadly speaking, we have a lower move in equity markets for the current situation. We are seeing yields mixed to pressured lower, commodities lower, WTI crude, you can see gold and silver, a little bit of flat after some initial falls. And we're seeing in the currency space, we're seeing some very traditional risk-off flows. So we're seeing broad weakness in the commodity-based currencies, Aussie CAD, New Zealand dollar, and broad strength in the risk-off currencies, yen, Swiss franc, US dollar. So it's a very traditional risk-off morning. Now, the market went risk-off on Friday, and that was after President Joe Biden announced that his large US stimulus package. So we had a sort of buy the rumor, sell the fact response. This wasn't entirely unexpected. Often when you have a market event that's expected for some time, when the event happens, quite often you get a sell the fact response. So you can see here from 9th of November, last year, we had the fact that Joe Biden won the US election. We had equity markets rising a few days beforehand. If you remember, those who were following the election, it became clear, maybe sort of 36 to 48 hours before the official election result, that it was almost certainly going to be a Biden win. And equity markets started rallying higher on the expectation of a larger stimulus package coming from the Democrats. Lo and behold, that's the case, and we have had a Democrat blue sweep, which was the Georgia state runoff, resulted in a victory for Democrats, and that made a so-called blue sweep, a larger stimulus package. So all this kind of expected larger stimulus package was boosting US stocks, and then lo and behold, you get the package announced and price sells off. Well, why is that? Well, it's because it's to do with anticipation. Markets work in terms of anticipation. It's like if I said to you, if I said to you on, February the 1st, I'm going to give you $100,000, well, what might you do? You might think, well, I'll start buying some things now in anticipation of Giles giving me $100,000 on the 1st of February. And the markets work exactly the same. So when they can see that a US stimulus package looks like it's coming, they're buying into the S&P 500 market in anticipation of that. And even when the stimulus package was, it was being argued, remember that into year end, will it happen, won't it happen? And then it was being delayed, and but the expectations were, there is a package coming. And then when you get it announced, you get sell the rumor response. Now, nothing's changed medium term. Medium term, we're expecting the same perspective for the world. Global vaccine hopes. There is a vaccine. It should lift economies around the world as people get back to normal. The globe should have a synchronized recovery. We should see upside in assets. So that perspective hasn't changed. We're just seeing a sell the fact response. And in the near term, even though that felt quite violent, particularly if you're intraday trading, this is actually quite a muted response. It's not a huge pullback, by any means. And if we put a trend line here on the S&P 500, we can see, well, all we're doing is testing that recent trend line around that 3750 region. And this is just simply a test of that trend line. And any deeper pullbacks, that 3765, in terms of the medium-term perspective, we'd still anticipate buyers. Exactly the same with the Aussie yen. But even though we've got, even though markets are at present risk off, they were on Friday, they are today. So it's not like we're expecting to see, it's not like we're expecting the Australian dollar, Japanese yen to necessarily appreciate much right now. The bias is for sellers. However, from a medium-term perspective, any area in this region, we'd anticipate buyers, because the medium-term bias remains to the upside. We can see we have a nice left shoulder, right shoulder, neck, head and shoulders pattern, very clear. We had a break to the upside, retesting the pattern on the technical side. Fundamentally, we also have that bullish perspective as well. Now, okay, Aussie yen could pull back lower. Even if it pulled back to 75, I'd still have that bullish bias. However, I may not stay on to the trade. I am long this in my own personal account, as well as a trading challenge account. So I have got an Aussie yen bias. Obviously, that's not trading advice. I'm just showing you how I'm managing my trades. So this area is potentially an ideal area for longs. You can see technically, fundamentally, and but if price goes back in that trend line, I may close the position, waiting for price to come back above and move higher. I am also long on this from a deeper pullback perspective. If you just look on the daily chart, there was a very nice head and shoulders pattern here on the daily chart. You can see here left shoulder, right shoulder, head, break to the upside, and just falling short of the ultimate target, which is the height of that pattern. Don't forget, you can look at that on my blog. You can go here to HYCM blog, and if you just put in head and shoulders pattern, you can find how to trade the head and shoulders pattern. I've got two here to look at. I've got one, how to trade it as a continuation pattern, and here's how to trade it as a reversal pattern. So the reversal pattern is the most traditional way of trading the head and shoulders pattern. So do make sure to check that out. I've sent it into the chat box, so everyone should get a sense of that if you haven't traded that pattern before. Very nice technical pattern. So with that being said, that medium-term bias remains, and the market is in one of those sort of crossroads moments. The crossroad between the medium-term fundamentals and the near-term sentiment. So the near-term sentiment is weak. So in the near-term sentiment, we expect sellers in the Aussie US dollar, sellers in the Euro US dollar, sellers pound US dollar, sellers New Zealand US dollar, expecting buyers US dollar CAD, and sellers in the Aussie yen, New Zealand yen. But in medium term, we expect risk assets to rally. Medium term upside in the Australian US dollar. So again, any retracement back down to that 7640.50 region could be considered suitable for buying. And even better pullback, any retracement back down to that 7520 region, we would expect to find buyers in the Aussie US dollar. Australian dollar, pro-cyclical growth currency. If the globe's going to recover, the Australian dollar stands to benefit. A recovering Chinese economy boosts demand for the Australian dollar. Recovering commodities, iron ore, copper in particular, boost the Australian dollar. The Reserve Bank of Australia, they finished their cutting cycle, so they're no longer cutting, and interest rates at 0.10% after RBA seems to be the near-term bottom. So medium-term Aussie US dollar bias is to the upside. Near-term, it's to the down. So that's sometimes how you have to balance these markets. You've got a near-term and you've got a medium-term. And sometimes the near-term sentiment, the weaker sentiment, gives you opportunity to buy into the medium-term at a better price. Obviously, we'll keep folks updated on that and do come back to the webinars on a week-to-week basis just to check into what that latest sentiment is. Now, with that being said, let's now look at the week ahead. Now, first of all, we have had a mixed picture from Chinese data. Remember that China at the moment is the #2 economy in the world, and some analysts are anticipating China to overtake the US as soon as 2028. So the growth of China is really rapid. It's a big story, and there's a bit of a shift, and there's going to be a power struggle going on that we can see going on now between the US and China, as both these huge trading bodies vie for superiority. The 3 largest trading blocks have been China, Europe, US, and it was US #1, Europe #2, China #3. The ranking has changed now. We've got US still #1, and we have China now as a larger trading bloc than the Eurozone. So, look out for the yuan. It's likely to become more and more popular and more influential currency going forward. And analysts and market participants all watch Chinese data carefully. So a lot of retail traders, they're not aware of Chinese data, or it's a bit of an anomaly. Remember, the Chinese data is important, and often the yuan, the Australian dollar, is traded as a proxy for the yuan. So what's good for China is good for Australia. What's bad for China is bad for Australia. So the Chinese data we saw was a mix. So GDP on the year was excellent, up 6.5% versus the 6.2% forecast. That's good. Industrial production was excellent, 7.3 versus 6.9. Retail sales were down, which is a bit of a blow. And the GDP quarter-on-quarter data, though it's not included here, was down. So mixed, 2 bits of good news, 2 bits of bad news. On balance, it just shows that the Chinese recovery is well underway. China's avoided that double-dip recession, and a very healthy growth rate of 6.5%. Could easily see, I have read some analysts looking for an 8% GDP growth for China for 2021. So, strong fundamentals for China, aside from this latest dot, as it were, this little bullet point in the economic data. Bank holiday is Martin Luther King in the US for this afternoon, so expect lower volatility in the US markets. Could be a bit quieter, so just to be aware of that. In terms of Tuesday, again, another general quiet day. There isn't anything particularly of drive. The only thing I'd say is watch out. There is a phenomenon called Turnaround Tuesday. From a seasonal perspective, Tuesday tends to be the best day of the week for the S&P 500. So would anticipate, if there's going to be a turnaround, expect a turnaround to come on Tuesday. So you could potentially expect S&P 500 buyers on that Tuesday coming in, and the risk sentiment is liable to be the main driver. When I say risk sentiment is the main driver, it's like today, the market was risk off. So we saw equities lower, commodities lower, yields a bit lower, and we saw commodity-based currencies selling off and safe haven currencies appreciating. That's the risk off sentiment, and it's driving markets, given the fact that we haven't got any new data and we've still got that hangover from last week. Tuesday, there'll be a reset, almost certainly, and it could be a positive risk on day. So just to be aware of that. There's no major top tier data that's particularly going to move markets. And in fact, looking at all the data as a whole, even though we've got some decent data points to look at, there's nothing here that's going to fundamentally shift the medium term picture of a global synchronized recovery. on vaccine hopes. Remember, a lot of people have been vaccinated now. Around 40 million have been vaccinated around the world. So, you know, the higher that number gets, the better it is, and also the closer we are getting back to normality. We do look like, as a nation and as a nation in the UK and as a globe, it looks like we're turning the corner in terms of the people being vaccinated. Of course, remember, the problem with vaccination is that I don't think in our lifetimes we've ever had a global vaccination program. So obviously, if you can imagine running that out across so many different countries, it's going to run quicker the further we go into that program, just because people are getting used to the systems, getting used to how they coordinate people, vaccinating people en masse. It's obviously like any job, it's a new one, and like all new jobs, you get better at it the more you do. So we'd expect the path of vaccination to increase speed, not decrease. So with that being said, Tuesday could well be a turnaround Tuesday day. Obviously, I haven't got a crystal ball, I don't know it, but just keep an eye out for that sentiment on Tuesday. Wednesday, now Wednesday we start getting more decent data to be looking at. First of all, we have the Bank of Canada rate statement. Now, Canada has been benefiting recently from the rising oil prices. Just taking a look at major commodities here. See that, you know, take a look at oil. I've been really impressed with oil's recovery, and it has been stronger than I anticipated it being. You can see right from November, from the Biden victory and this general, you know, hopes of stimulus, hopes of reflation, hopes of a vaccine, all of this, particularly the vaccine hopes, just stimulated stimulated the oil. And we've seen that strong upside in oil, and that's in the opposite in gold. We can cover that in a minute, but that upside in oil benefits the Canadian dollar. The Canadian economy has a huge oil export economy, has a lot of oil sands which it extracts oil from, and that's a big boost for the Canadian economy. So it'd be interesting to see whether the Bank of Canada is turning more optimistic. At the moment, they're keeping rates flat, 0.25%. They're not expected to change interest rates, but it'll be interesting to see what the Bank of Canada's perspective is. So one to watch, keep an eye on Bank of Canada. It'd be interesting, very interesting to see how they're reading their domestic situation. There could be an opportunity for the Canadian dollar out of that. As I said, I'm not expecting anything, but it is one I want to look at. Remember, when you get a policy report and you get a press conference, remember, don't see these as two separate events. See them as one event. So in other words, you might get something from the rate statement that then gets reversed by the press conference. So what you don't want to do is go to the rate statement, read a sentence which is like bullish or negative, and think, oh yeah, I know what's happening with the CAD. Get the press conference as well, and make sure you understand to read them both. Now, Governor Bailey is speaking. That's going to be important for the pound. No doubt he will mention something about negative interest rates. Remember, last week, Bank of England Governor Bailey walked away from negative interest rates. This was a trade I took on my own account, shorting the euro pound. I shorted the euro pound based on the fact that two things. One, we had Bank of England's Bailey walking away from negative interest rates. And number two, we had a negative outlook for the Eurozone. So you can see here, I just took a short around 13th of January, around 6 o'clock, just took a short on this break here. See that little trend line, still got that in place. Just took a break here, stops above the high, moving down into lows, and just took profit down. I think I got pretty much perfect exit actually, 0.8870 something. So nicely managed to time that literally perfectly, with the price now going back up to my entry point. Now there is a potential here for shorts at this level, with the bearish bias still in place and that trend line being tested. So there's potential for shorts there, with stops running about 0.8930, looking for a move lower back to 8.80 on very similar kind of perspective. It's not a trade I'm getting into, but it is one that would be a possibility. So what we'll see is, does Governor Bailey reinforce the fact that he's talking against negative interest rates? Money markets have been pricing in negative interest rates from the UK. So that led to pound buying when Governor Bailey last week said that they were, he reduced expectations of the Bank of England going to negative interest rates. So do check that out. Governor Bailey speaking, could be volatile for the pound, worth having a squawk on, worth checking out the news. 5 p.m. on Wednesday, could see some volatility in the pound, definitely look at. Employment is important for the Aussie. Now, this is not going to necessarily change sentiment, of course, but the RBA want to see employment picking up before they even sort of even thinking about raising interest rates. They haven't mentioned about raising interest rates, but employment is important. So again, with the employment, what we want to look at is the full-time versus the part-time. We want to see more full-time rises. The headline is 50,000 expected. So anything above, 100,000 is going to be positive. The more full-time jobs increases there are versus the part-time jobs is better. So full-time jobs are obviously better than part-time jobs. So what we want to see for Aussie strength, obviously looking at the current sentiment, if the risk-on sentiment is still there, if we're risk-on markets, then anything strong here will be a good boost for the Aussie. Unemployment rate, want to see that drop. So at the moment, it's 6.7%, pretty high. Has been pulling back from the COVID-19 highs, but the RBA wants to see this keep dropping lower. It's one of their key markers for the economy. So if employment picks up, unemployment drops, then that's going to be good news for the RBA and good news for the Aussie dollar. So it's not like a massively important data point at all, but it is a sort of move you get sort of 15, 20 points from. So worth being aware of if it happens. Bank of England monetary policy report. No fireworks expected there. Expected to be on hold. Bank of Japan hasn't changed for years what they've been doing with the interest rate statement. So no fireworks expected. But obviously, there is a change. You can get some volatility, so be aware of it. Particularly if you're trading the yen into Thursday, you might want to be aware of that. But no changes expected. Then we have interesting ECB monetary policy statement and main refinancing rate, and the ECB press conference 45 minutes earlier. It's just like Bank of Canada. Remember, you want to look at these two data points together. It's not just the rate and the statement, then don't just go away. No, you have to stay for the press conference. Often you'll see the statements move reversed with the press conference. Now, the expectations, no interest rate change, but the ECB has a problem, and the problem they have is very low inflation pressures. So they have deflationary pressures in the Eurozone, and the fact that there's been rising COVID-19 cases, we've had Germany's economy slowing down, we have had some pressures on the Eurozone. It'll be very interesting to see how Christine Lagarde responds to those pressures. So opportunities potentially with the Euro. Do make sure you're around for that. Now, interest rates are expected to remain as they are. Obviously, if they dropped, that would be a clear sell the Euro situation. And watch out for any potentially expansion of asset purchases. If QE expands, we could see that supporting the Euro because it's showing that the ECB are supportive of the Eurozone. So usually quantitative easing weakens a currency, but if there are asset purchase increase, that could end up supporting the Euro. So that's a key event to watch. Nothing's expected to change the big term, the medium term picture, but there still could be some surprises there, and there could be some points to be had. So take an eye on that. CPI data out of New Zealand, that's what I'd look at. That's going to be important, I think. If you just look at the Aussie New Zealand dollar, let's just take a quick look at that. Aussie New Zealand dollar now. So you can see here the Aussie New Zealand dollar. We got the Australian dollar just continuing making ground against the New Zealand dollar. Now that's because of the slightly more optimistic perspective of the RBA as opposed to how it has been. Now, if we just look at the bond yields of Australia, and if we just look at the bond yield spread between, now let me get this, let me just do this. That's it, right. Now, the orange line I've got on is the bond yield spread between the Australian 10-year bond and the New Zealand 1-year bond. So what the yield spread basically tells you is the risk profile between the two countries. So when the orange line, the bond yield spread between the 10-year bonds of Australia and New Zealand goes higher, that's a more productive environment for Australian dollar longs. When the Aussie 10-year, New Zealand 10-year bond spread drops, then that's pressure on the Aussie New Zealand dollar to the downside. So what you can see at the moment is not quite a divergence, but you can see that there is a little bit of a gap opening up here with Aussie New Zealand dollar rising higher, but the Aussie New Zealand 10-year bond yields were staying quite flat. So, you know, on the balance of probability, what you'd expect here, you'd expect that the Aussie New Zealand dollar to drop back down towards the yield spread. Okay. Now that's why something like the CPI data, the inflation pressure, is quite helpful, because on Thursday, say you got a decent reading. Now we look at recent readings for the CPI quarter on quarter, and we've had 0.7 was the prior. It was minus 0.5. So say we got something like above 1, okay, then that would be very positive for the New Zealand 10-year bond. And that yield spread differential would pull the Australian 10-year bond, New Zealand 10-year bond spread lower. And that would potentially drag down the Aussie New Zealand dollar. So a spike higher in New Zealand CPI inflation could be a good opportunity for shorting the Aussie New Zealand dollar 10-year yield. You know, one potential way of trading that is if you did get that, you know, trading a break of the trend line. Okay, that trend line higher, just trading for a break, stops above the highs. So that's one to be looking. It's worth looking out for that come on Thursday. Friday, got loads of PMI data out of the Eurozone. That's going to be important, particularly in light of what the ECB have said on Thursday. The more these drop lower, the more negative pressure that does weigh on the euro. Any pump to the upside will be supportive. But you've got to balance that in conjunction with what Christine Lagarde says. Don't forget to come back on Wednesday. We will be looking at this again on Wednesday. We'll be having a little look with the monetary policy report. So do pull back in here on Monday, and we'll get ready for that monetary policy report together, as well as I'll then identify a key market for trading in the medium term. We're expecting, you know, medium term buyers 3675, any drop down there. Expect medium term buyers at current market prices, you know, trading at market. You expect, you expect movements high as long as we're above that trend line. So stay above, then bulls are in charge. Looking at the Aussie yen, expecting buyers from market, and any pullbacks down to that. So that 79 region would be the best potential region for going long. So for trading from market long, or 79 would be a potentially nice area for going long in the Aussie yen from a medium term perspective. So I hope that's helpful. I hope that just tunes you in to what we've got coming up. Don't forget to be back here on the Wednesday. I'll just go back to the main screen. And Wednesday at 12:30 GMT, come back here and I will highlight the key markets for that day, as well as looking at the Bank of Canada report that we have coming. Thank you all very much for attending. I hope everybody is well, keeps well, and I look forward to seeing you guys on Wednesday. Yeah. Cheers, Will. Thanks, you. Cheers, guys. Take care, everyone. Now. Goodbye.